without any further ado, let me introduce why we are here. We are happy to host this webinar, which is entitled Demystifying Concepts in Impact Investing. It's being led by our able faculty bench here at Strathmore, Kanini Mtooni and Stephen Gugu. And it's in a collaboration between Strathmore University Business School. So they were premier business school hosted here in Kenya, in Nairobi. We also in partner with Investia Capital, which are also part of this conversation. And these are wider part of our upcoming program that we host here at Strathmore called the Private Equity and Venture Capital Training. We have picked this topic just to give us flavor of a wider conversation around private equity, and our key focus will be on impact investing. This program, our private equity, enables our participants to understand this particular asset class called private equity, help you to understand the risk, help you to understand potential returns around private equity, and also how you as an investor can incorporate private equity into your portfolio. We also enable you to gain skills around evaluation of these asset class. We also help you to value, structure, and negotiate these asset class. We help you to add value to your private equity arrangement. We also help you to review and strategize around exit strategies. We help our entrepreneurs and investors understand the challenges and opportunities around private equity. And most importantly, we give participants opportunity to network and have conversations around how we can improve our private equity arrangements. And I know this is being unpacked by a very able faculty bench. We have this program coming up in a month's time, that is 6th to 10th March 2023, and we deliver it here on campus. And it's being unpacked by a resource faculty bench. You can see them on your screen. Stephen Gugu, Saranga Mau, Tony Wainaina, Matthew Mtua, Kanini Mtooni. All these are industry players who come and unpack this program. So just diving into our conversation for the day, Stephen Gugu on call. I will invite him with academic director. He will introduce himself and also introduce fellow panelists and also dive into the program. I want to invite you and also get maximum output out of this 1 hour. Thank you very much. Over to you, Stephen Gugu.
Thank you very much, Andy, for the kind introduction, and thank you for also mentioning a few things about the program. Maybe before I call in Kanini into the conversation, this is one of those programs. I think if you're interested in this space of venture capital, private equity, impact investing, and you want to dig into that, I think you should attend it. And the key reasons, because for me, there are 3 key reasons. The first is, the faculty we have is super experienced. Today, you get a sample, a taster of one of the faculties. Kanini is my friend, but also very experienced in the impact investing space. And all the other faculties that were illustrated, they are also very experienced in the respective areas and they operate. Secondly, is the networking element. The fact that you get to meet with other players who are trying to do something similar, whether it's to bring a fund, whether it's to evaluate investments, whether it's to dividends, etc., whether it's to exit deals. So you get to meet with all these different people. Thirdly, of course, is the content itself. The content is really good. It's been well curated. Over time, we kept on shifting the content to make sure it is tailor-made to the market. We've not had the impact investing session before, but we thought, based on where the market is going, is one of the most relevant spaces to think about. And so I'm really glad today that we have Kanini joining us. Kanini Mtooni. Kanini is one, a friend, but two, she's the LD Managing Director at DIK Foundation. She'll speak more about what she does on a day-to-day basis. And she's one of our core faculties for this program and focus on the impact investing model. if you Google impact investing across Africa, Kanini's name will definitely pop as one of the top names in there because of the work he's been doing to promote impact investing. So Kanini, I want to say anything else about you. I'd like you to do a more in-depth introduction about yourself, and then as you're speaking about that, maybe you can also just introduce the concept around impact investing. Welcome, Kanini.
Yes, thank you very much, Stephen, for that very warm welcome. I'm so excited to be doing this webinar, Stephen, because, and we've called it Demystifying Impact Investing. You know, people use impact investing in so many different ways these days, and sometimes I cringe because in many instances, there's a huge lack of clarity around what it really is, what it really does, how it can help change the world, and how it can influence how investors think. So I'm really excited to be part of this conversation. As you said, I've been on this journey for a long time. I like to say I was part of the journey even before we coined the term impact investing. Over the last 15 years, I am a practitioner in impact investing myself. I run the Africa portfolio for Draper Richards Kaplan, which is an impact investing portfolio. As well as that, I also am involved in a number of intermediary impact funds, a little bit larger scale that deploy capital to private companies. I'm also involved on the listed side of impact investing, mainly on the European side. So Stephen, just to say, when you think about impact investing, it really isn't an asset class. In the beginning of this introduction, we talked about private equity and venture capital. I see impact investing as a philosophy, not an asset class, because it goes all across the other asset classes, fixed income, listed, private capital as well. So just out of the bat, I would say, let's not define impact investing as an asset class in itself. It's a philosophy in terms of how we deploy capital across various asset classes. Thank you.
Thanks. And I think already getting the facts straight, which I think is very important. And I like what you mentioned about, creating, because I think impact investing has been thrown around. So the terminologies like impact investing, social entrepreneurship, impact, I think making impact measures. I mean, there's so many things just thrown about. So maybe if we just start from maybe just the terminologies first. What would you define impact investing as? There's also social entrepreneurship and any other terminologies that you find that people confuse, just to make sure that we get the terminologies right as we move ahead.
Yes, and that will be part of the course, Stephen, that was just introduced now. And we have a whole section diving really deep into the terminologies that are used. But just as a highlight, I would start off by defining impact investing as simply deploying capital with the intention of generating both financial returns as well as social and environmental returns as well. The next question I'm sure people would be thinking of is asking, what is the difference between investing normally and impact investing? And my response would be, impact investing is really what I call three-dimensional, Stephen. It's risk, return, and impact, okay? Three-dimensional. For me, mainstream investing, which is where I actually came from, is two-dimensional. So it's just about risk and return. So if you want to sort of delve into the differences, that's the first place to start. Three-dimensional investing versus two-dimensional investing. Now, the next question people ask is, as you've said, what is the difference between terms like ESG? So ESG is something I'm sure all our listeners have heard bandied about in the media. So E is environmental, S is social, G is governance. So ESG is what I would call the basic part of impact investing. ESG is basically a screen that investors have to tick against how they deploy capital. I'll give an example. If you have a fund or an individual who doesn't want to invest in, say, arms, fossil fuels, or anything that involves child exploitation, they will use ESG as a sort of screening tool to decide what they decide not to deploy to. So we call it, Stephen, the do no harm principle. Now, unfortunately, some people imagine that ESG is the same as impact investing. No, ESG is just the first step in thinking through how to deploy capital. Impact investing is a step after ESG. And in many cases, we find that people stop at the ESG level and never actually go deeper to say, okay, we've removed the do no harm principle. How do we dig deeper and really deploy our capital to solve major problems in the world and to create impact and to generate a financial return? So I would say that's the first differentiation there. And then to your point around social entrepreneurship, this is another term that's used everywhere. It's actually very simple. A social entrepreneur is simply an individual running an organization that is going to solve or is aiming to solve a major social problem in the world. Okay, that social problem could be inequality, income inequality, it could be health inequity, it could be financial inclusion, it could be access to water, access to clean energy. Any problem that is a social problem that is being solved by an organization, that organization is a social entrepreneurship organization. And lastly, it could be a for-profit and it could be a non-profit, okay? It doesn't necessarily always have to be a for-profit to be defined as a social entrepreneurship.
That's even to me. But now, and sorry, I know we are getting to unscripted territory now, but I think this is an important question based on the stuff that you just mentioned. So would you then say that impact investors, and this, I guess the listener would be interested in this, do impact investors only invest in social entrepreneurs, or do they also invest in mainstream businesses?
That's a great question, Stephen. And the answer would be, it depends. And I'm not a lawyer, I know. But I think just to take a step back, as an impact investor, remember we said it's three-dimensional in investing, right? Risk, return, and impact. So as an impact investor, my intentionality has to be around solving a particular social problem. Now, that problem could be solved in many different ways, okay? It could be solved through a mainstream, mature business organization, or it could be solved by an early startup organization that is 1 year old. So in my mind, there's a wide array, as I said, of asset classes that an impact investor could deploy their capital to. So let's not get bogged down with thinking that social entrepreneurship must be a 3-year-old organization, early stage, early, 3 years out of the bat. No, it could be a mature organization, which, for example, has decided to pivot. A very good example is our old fossil fuel companies that a lot of activists detest, that have actually decided we're going to set up a separate entity purely around renewable energy. And we're going to do everything that we can around investing in the technologies for renewable energy. Now, Stephen, a lot of people might laugh at these companies and say this is PR, but for me, that's a great example of an old, mature company deciding to deploy or invest its capital with a really clear social aim to stop plundering the environment.
So thanks for that clarification. So the last point on the introductions, in comes SDGs, right? How do you then correlate the concept of impact investing and SDGs? Because these are all terminologies which are used in the same paragraphs, if you want to call it. So how do you correlate those two terms?
Great question, Stephen. And this is something as well that I have to say unnerves me when you see, for example, either a fund pitch deck, which is beautifully done, and the first page is the SDGs, and they put probably all of the SDGs, and they say our fund thesis maps to all the SDGs. Then you go to the next page on the deck, and there is nothing around impact or measurement of impact. Now, the reason why I become unnerved is the SDGs are a beautiful way for the world to almost convene around the key social problems in the world. For me, that's what I see it as, just a guideline to start from. So whether it's access to water, access to housing, access to energy, all those are just a guideline, a baseline, if you like, for where to start from. But that really isn't where impact investing should start. The next step below the SDGs is where impact investing comes in. Okay, let's be specific. If we're focusing on SDG 4, let's talk about how are we going to measure if people have access to energy? How are we going to clearly define who is the target beneficiary of that particular problem that we're solving? Okay, how much return are we expected to get from this deployment? The SDGs are beautiful, but please don't stop at the SDGs. That's just a baseline for the world, nothing more.
Okay, thanks for that. And I think for the listeners or the participants, already you can see, Kanini understands this space really well. And I think he's being able to sort out the puzzle so that we know exactly what you're going to be focusing on when you come for the program. Of course, in the program, we'll dig much deeper into all the different aspects. So Kanini, let's now go back to the macro picture. So I'm sure there's someone who was asking, so then tell me an example of an impact investment that has worked that we can speak about, just to try to contextualize this.
Yes, and Stephen, what I'll do is I'll use my own examples of for example, our portfolio in terms of what I see as a classic impact investment. So the way you started the sentence, Stephen, you said has worked. Now, I see impact investing as a journey. Okay, from the moment you identify, for example, an organization, an investment, to the point where an exit happens, which may or may not happen, that is a journey. So I don't see it as being a place where we get to, that we make an investment and we say, yeah, we've done it. It really is a continuous journey even from diligence to investing all the way to when the exit happens. So I think one great example for me is in the affordable housing space. I think we all know on this call that affordable housing is one of the chronic problems on the African continent, not just in East Africa, but in West, Southern, Central. It's a chronic problem across the board. So we have a company that we discovered right here in Kenya called Kwangu Kwako. And what Kwangu Kwako does is that it works with landlords in informal settlements to help them build permanent housing that is then rented out to beneficiaries. So people who would be living in a, informal settlement, in a mud sort of basic construction without access to plumbing, without access to electricity. This investment of ours basically helped Kwangu Kwako build permanent structures for landlords to then rent out to people who would be renting them. And the first time I heard of this concept, I asked myself, shouldn't it be the other way around, that we just build permanent housing and get people to rent? No, what I liked about this was that we're actually increasing incomes for the landlord. Return, remember, we talked about return. And at the same time, we're also creating a dignity and a dignified space and access to energy and access to water for those who will live in that particular settlement. So again, if you think about it, for me, when I approached this, I saw risk. There's always risk. There's always execution risk in every deployment of capital. I saw potential return, okay? Over a period of time, there will be return going to the landlord, and there will be returns coming to us as an investor. And then thirdly, there is a clear social impact. How do you measure it? How many people have lived in the house? How many of them have access to energy? We can measure energy in kilowatts. How many of them have access to water that didn't have water? So Stephen, if you start to see the threads here, I'm not just talking high level, I'm talking specifics. And that's how at DRK, we really look at the criteria before we deploy any amount of capital. All these three things need to be in there, and they need to be very clear at the same time. So just to finish this train of thought, one thing that we are trying to do in the sector is structure deals in a way that reflects the impact that we're trying to make. So with Kwangu Kwako, what we did is we are hands-on investors as DRK. So we took a board seat, and through that board seat, what we have done is we've worked directly with the entrepreneurs to really help them understand, how do you scale? You started with 100 homes. How do we get to 400, 500, 600, 1 million homes? How do we get to more people? How do we get to larger access to energy and water? And there's so many things, Stephen, that you can do from a portfolio support perspective that can help entrepreneurs get to that scale. And again, that is part of the impact.
Thanks, and that really goes to contextualizing exactly, the impact investing philosophy. So let me throw a curveball. One of the things the government of Kenya is doing is, housing is one of the key objectives that the government has set to look to resolve in the next couple of years. Would you say the government is an impact investor in this context?
Great question, Steve. And actually, I'll say to you, part of the course, the impact investing course materials is there's a section that I call the stakeholders in impact investing. And government takes, I'll probably say 3 slides. And the first time that I presented this to impact investors in the US, there was a big question, like, you mean government is an impact investor? Absolutely. So government is an impact investor because think about it, they're deploying capital, right? And lots of it. I was going to say Kwanzaa, but let me not say that, but lots of capital. Number 2, they're taking risk because that capital could actually be deployed elsewhere, okay? But they're taking the opportunity cost and the risk to deploy capital to affordable housing. And then think about it, there are potential returns because this is not charity, this is not philanthropy. There are potential returns that could come from that investment. So 100% governments are impact investors. Another example, Stephen, is the DFIs, the Development Finance Institutions. And for those on the call who are not familiar with this, these are the institutions that are funded by government taxpayer money to do private investment. So in the UK, it's CDC/BII, British Investing Institution. There is FMO, there is African Development Bank, there is Trade Development Bank. All these institutions are funded by government money, but their mandate is to do private investing. That is a form of impact investing as well.
Okay, thanks for that. And, I like that because now I'm starting to get the point you're speaking about. It's a philosophy, right? And in that philosophy, you need to be very deliberate to identify the impact, to measure the impact, to report on that impact, right? Which now, I guess for the people who are attending the session, that starts to clarify things. And of course, if you have any questions, please do type those in the chat. I'm going to start picking questions from the chat in a second. So, Kenny, let's now also just go in and ask, what's the current state of the impact investing philosophy, at least within the region? Maybe we're going to focus on Kenya, on East Africa, in terms of, being used by investors, in terms of being recognized by investors. What's your sense of how that's happening and what we need to do to accelerate that, assuming it's not where it should be?
I mean, yes, Stephen, I would say out of the bat, it's not where it needs to be. My sense, because I sort of move between Europe, US, Africa in my work, my sense is Africa, we're still nascent around the philosophy of impact investing. And it's not because we don't do it, but my sense is that I don't think we're being intentional about going deeper in the space in terms of how we're deploying our capital. So I'll give you an example. I still hear the phrase, investing in Africa is always going to be impact investing. And that is not correct, because just because you're deploying capital on the continent, it doesn't mean you're going to cover those 3 things that we talked about earlier: risk, return, impact. There's a lot of capital deployed here that is not impact orientated at all. So I think that's the first thing. They're still using the term, and there is still a lack of intentionality about the how. I think the other thing, Stephen, here is that my sense is we need institutions like Strathmore to be able to help with the education piece of impact investing. Because if I look at South Africa, I was on the faculty of the University of Cape Town, which has been running an impact investing course for about almost 4 years now. And that's really helped bring up the concept and deepen the understanding. I feel Kenya is going to be next, and we need, highly regarded institutions like Strathmore to be able to help with the education piece, because there's a lot of deep education that is required. When I look at Europe and the US, the institutions that I've been affiliated with, which have been running impact investing courses for probably 10 years now, and it's actually part of their curriculum. And that, I feel, has really helped push the philosophy into the institutional side, into the social entrepreneurship side, and the government side. So I feel that's what needs to change going forward. And I'm very passionate about it. That's why I'm doing this webinar today.
And thanks, Kanini. I think from an SBS perspective, we are very happy that, you're on board in terms of, this evangelization that needs to happen to make sure that this is, taken seriously. It takes a position it should, because at the end of the day, from where we live, impact is such an important thing. We need to create jobs, we need to solve so many problems which are there in the ecosystem and so forth. Now, there's an interesting question from Kimathi. Sorry, you wanted to say something before that?
I wanted to just to add quickly, just for a global view for everybody, in terms of people trying to understand what is the quantum. We're now at $1.7 trillion in terms of the value of impact investing assets. So remember, we talked about it as a philosophy. So if you move from the philosophy and put it across the asset we talked about, private equity, venture, listed, fixed income, it's now at $1.7 trillion. So massive. Thank you.
Okay. I guess someone would ask, just to follow up on that question, how big is that? Because it's a big number, but if you take the whole quantum of the total investment, is that 20%? Is that 1%? Is that 50%?
Great question, Steve. It is a drop in the ocean, because when you look at mainstream investing, it's in the hundreds of trillions of dollars. So we're excited about getting to the 1 trillion mark, but I think the worry and the motivation for me is to really get to the point where we're neck and neck with mainstream investing, and it is very far still, I have to say.
Lots of growth there. Okay, so I think there's an interesting question which has just come from Kimathi Ukiao. And so, and I'm going to read it verbatim. Following the Kwanko example, the impact on the front end is clear. How about the impact on the back end, i.e. environmental impact on the quarries? How do you balance impact in those kind of situations?
That is such a great question from Kimathi, Stephen. And I think as impact investors, we're always thinking about what I call net impact. Okay, and that's something that we would go through in the course. When I talk about net impact, what I'm thinking in my mind is there's going to be positive impact. Okay, we know what the positive impact is, but there's always going to be what I call negative externalities or negative impact. So what you need to do as an investor is map those two together and come up with an overall net impact. And that net impact has got to be positive. Now, this is the thing that we struggle with the most. So going to Kwango Kwako, of course, they need to use concrete in order to build the panels that then end up building the homes. So one of the things that we've done with our investment is that we've said to them, okay, let's look for environmentally friendly ways to do the construction that you do. We found a way to use less concrete, which means plundering fewer quarries. The second thing that we found is a way, and this is now getting technical, just a way to mix the concrete before you plaster it on the walls in a way that reduces the amount of water that we're using. We've even found a way of using a circular economy system to make sure that we're reusing the water that's coming out from the process of construction. So all these things are what I would say are ways of how to reduce the negative impact and push through the positive impact. Because Kimathi, if you think about it, there are millions of people who do not live in homes that have electricity, that use what we call in Kenya flying toilets.
Hello, Kanini. We lost you there for a second, Kanini. I think we lost you at the... Yeah, we can hear you now. We lost you at the point where you mentioned the flying toilet problem, and then you cut off at that point.
Okay, so I was just finishing. I was saying that the ultimate thing is to map positive against negative. Flying toilet against the negativity around the environment, but really as an investor pushing for those processes and innovations that are going to help promote the positive impact and reduce the negative impact on the other side.
Thanks for that. And there's another interesting question, which I think just naturally leads from that question. I'll read the verbatim there, I'll create a bit of context so I understand where this question is coming from. And this is from an anonymous attendee. So as an impact investor, how do you demystify between real impact investable businesses and carefully curated businesses only skewed towards seeking impact investment? And I think, this is one challenge that has been thrown, right? And I won't name any company. Let's talk about digital lending for argument's sake, where, there's this whole story that, financial inclusion, we need to provide funding to people to be able to run their businesses, to do whatever. But then when you compute the interest rate, the interest rates are, crazy. And so you almost feel like this business, while it's been created as an impact business and has been pitched as that, when you look on the ground, there's no real impact. There's some impact, of course, there's net impact. I don't know how you're going to score that. But then now to that question, I was just trying to create context. How do you balance through that as an impact investor?
This is honestly one of the things that we have to do every day and we struggle with. And honestly, Stephen, at the end of the day, this is sometimes more of an art than a science. So, the example that you just used on financial inclusion, we have seen those lenders in the market. We know who they are. We won't name names. And we have seen the negative impact that they've had on the ground in terms of their lending practices. Now, for me as an impact investor, the first thing that I usually ask myself is, and you can see when you speak to an entrepreneur or when you look at a deck, how integrated is impact in the business model of the entrepreneur? And I'll repeat it. There has to be integration of impact, which means impact is baked into the business model. Now, the example that we're talking about, Stephen, in this sense, for me, impact is not baked into the model. If you ask me, how can a financial inclusion business bake impact into its business model, other than having interest rates that are not considered to be exploitative is one. The other way of baking in impact into the business model is ensuring that you're working with the underserved, making sure that you're not exploiting them further, or you're not putting them in a worse situation than they were when you first came to help them. So there's got to be things that are being done that are baked into the model that clearly show that impact is integrated. Now, I'll just tell you one test that I use when I talk to social entrepreneurs to understand, is this real or is this just somebody who's packaging this business as an impact business, but it's not? Simply ask them, what does impact mean to you and how do you intend to measure it now, when you're scaling, and when you exit? And just be silent and hear what they say. Because if an entrepreneur is really integrated into the impact story, they will have a very clear intentional answer about impact in those 3 stages of the life of an organization. Many, and unfortunately, I have to say it's probably 94% thereabouts, who are just not able to answer that question in a way that is intentional. But we're hoping with this course, for example, Stephen, which actually appeals and should appeal to social entrepreneurs, they will be able to answer that question in a lot more clarity.
And I'm going to use a very specific number, 94%.
That is from that is from my interactions, and maybe to say the evidence is that more than the majority, unfortunately, are not in a position to talk about this in an intentional way.
Yeah, that was on a light note, which I think naturally leads to the next question. Joe, J.O., I don't know, Joe, I'm going to pick your question in a second. So, of course, I think at the heart of that question is also the aspect of balancing return and impact, right? Because I would imagine part of the reason why these businesses will go out and probably charge, interest rates which are, exploitative. They'll say, if you balance the risk-return framework, this is very risky. We need to charge more, etc. I mean, they'll have their own argument in terms of doing it. And of course, there's also the push from the investor in certain instances in terms of the kind of target return they want to see, despite the fact that there's also impact being considered. So how does someone go around balancing those two aspects, right? A typical fund would expect to have probably a 30% IRR year on year, right? Of course, they know that some of them will not make it, so they'll go for a much higher return so that the ones that don't make it get compensated by the ones that do, and so forth. So I'm just imagining in that kind of context, imagining your impact fund, how do you then balance these two perspectives?
Yes. So now we're going to the meat of it, Stephen. What I'll start off with, the question was specific around methodologies and in terms of evaluating an impact investment. What I'd like to throw out now is, and this will be part of the course, is there is a methodology called the ABC methodology by impact assets, okay? So that is a very clear step-by-step scoring methodology that we use in order to determine if something is an impact investment or not. Now, I don't want to go into it in too much detail because we don't have that much time, but for anybody who's listening, you can even Google the ABC methodology for evaluating impact investing. We will go through that in the course. Now, to your point, Stephen, around returns in particular, we have to remember that there are three types of impact investors. Sorry to complicate things even more. There are impact investors who are looking for at-market returns. So their return on the return continuum, they're just aiming to be where the market is in terms of return. There are others who are even happy to have below market returns, or what I would even call concessional returns, okay? And then there are others who insist on above market returns. And those are the ones that you're talking about, 30% IRR. If it's in the venture world, they're expecting to have a home run 5x, 10x, 20x. Now, for those of us on the call, if you want to understand the kind of impact investor you're dealing with, that's the first question you should always ask. What is your return profile? Where do you sit in terms of what I just explained? Once you understand that, then you can go to the next question and ask, okay, how long do you expect to hold your impact investment? Is it 2 years? Is it 3 years? Is it 12 years? Or do you not care? Now, when I say do you not care, that's what I call patient capital, Stephen. And for us at DRK, we don't have a specific period during which we have to exit an investment. For us, we're just about working as much as we can to create that impact. We have a long-term view, we have patient capital, and an exit may happen. We have had exits. I will not, I'll be honest, we've had exits, but they were not exits that we pushed. The market just made it happen, and we still continue to measure impact even after the exit, okay? So I have to make those points clear. The holding period, where do you sit on the return continuum in terms of the categories that I gave? I hope that's helpful.
I think that's very helpful. And I think, we are digging to the meat, and I know, we've not even scratch the surface because the program is a whole day, right? And so if you want to dig deeper into some of these questions, then you just have to attend the program. Now, I think today we're just having interesting questions. I know interesting at times is thrown everywhere, but this indeed is an interesting question from Abel K. I know you probably read it, but maybe some people have not read it. So let me just repeat the question. So there's a contrarian view emerging that environmental goals are being muffled by having the politics of social and governance goals in corporates when it comes to ESG. So we see companies like Exxon, who are big polluters, being included in ESG indices, while Tesla, a carbon negative company, is being kicked out of indices. How can an impact investor cut through the noise? Since impact investing is being taunted as virtue signaling, given the muddy water the market has made out of the agenda.
Mr. K, you're asking the right questions. Okay, so I know we don't have much, but let me just give you where I stand on this. Okay, first and foremost, ESG has become political. We cannot escape from that. Largely from the US perspective, you have Republicans and Democrats and independents all having, to be honest, quite different views about ESG. And even in some instances, demonizing institutions that vaunt and say they have ESG credentials. So I think, Stephen, let's just agree on that. This has become extremely political, actually in Europe as well. The second problem we have as far as ESG is concerned is that we still don't have a uniform way of, for example, asking, when we talk about the indices, just for our listeners, these are a basket of listed companies that are labeled as being great when it comes to ESG. We don't have a standardized way of determining who gets in and who gets out. It's simply determined by the large institutional holders of those equities. So there's a bigger problem here around infrastructure, around labeling, and also around the fact that ESG assets and funds have quadrupled over the last 5 years. And Stephen, I've actually seen funds which did not have the ESG label in January. By December, they've changed the label and they say now they're ESG. And you can't understand what has changed in the underlying construction that has made the fund change its name. So I think this is a big problem area. But you know what, with everything that is good, there's always problems. And I think this is what we as an industry are trying to come to terms with. Uniformity, okay, better clarity around indices and how they're constructed, and then helping companies understand what do they need to do to maintain entry in a particular label. Abel, I think we will cover a little bit of this in the course, but this is an evolving space. This is definitely an evolving space.
Yeah, and I like those comments, starting off from the fact that these have become political. And it naturally leads me to the next question. So you're a fund or you're an investor. You are raising a fund, you already have a fund. You're like, this is fascinating. I want to get onto the impact investing side of things. So first of all, how do you practically sort of start thinking about that? Some practical steps, 1, 2, 3s. And then what kind of challenges should you anticipate? Because I'm sure it's not plug and play, let's go.
Stephen, what I'll say out of the bat is immediately you're going to be in a very crowded space at the moment, even especially Africa. I mean, the number of new impact funds that are starting is phenomenal. I mean, there's a huge number. So immediately just realize that you will need to differentiate yourself as a fund and from a thesis perspective. So what I'll do out of the bat immediately is say, you need to come up with an investment thesis for your fund. Why do you call yourself an impact fund? What are you going to do differently from a mainstream fund? Immediately, there has to be that clarity. And then there needs to be a clear focus on why. Why are you doing impact? and you could easily just do a commercial fund. Now, the cynical answer to that, Stephen, is that, of course, there's a lot of capital available for impact at the moment. So lots of people are going down this path because they think it's going to be easier to raise and close a fund because it has the impact label. But you have to be very careful. We are also very sophisticated now as impact investors to be able to see the differences. Yeah, your impact thesis has got to hold very strong. Just quickly on top of that, if you're starting a fund, you need to have a pipeline or a warehouse of the companies that you're intending to invest in. And very quickly, when you look at a pipeline, you can clearly see, is there an impact intentionality around this? Gender lens is a very common theme now. That is a form of an impact fund. When I look at the pipeline, I immediately ask the question, why this company? Is it just because there's a female founder? Is there a female board chair? Is it in a sector that is focused, highly proportionately on women and girls? Those are the deep questions that would be asked by a potential LP or limited partner when I look at an impact fund deck. Lastly, for your own fund, you need to have an investment committee that really shows your credentials as an impact fund or as an impact investor. And that could be anything from making sure you have representation, equal representation on the IC, even to the extent of making sure that if you are an African fund, you're not sitting in San Francisco and claiming to invest in West Africa. You've got to be proximate to where you're investing and allocating capital. That's actually something very practical to think about as an impact fund. So again, just a few nuggets there, but this is a subject that I absolutely love because I act as an advisor to a number of funds. So this is something that we plan to include as well in the course.
And thanks for that. So I'm going to switch hats just slightly. When we were sort of marketing the webinar, we also marketed to entrepreneurs. I mean, one of the things that I do is that I'm managing principal for Investia, and we invited a number of our clients to come in and listen into this, probably even attend the course if they want to attend it. And this is the last question before we go to closing remarks. Now, one key challenge that I've found when you're dealing with entrepreneurs who are receiving impact investing is when there's a feeling first that impact investors would tend to complicate an already complex business, so to say, because of some of the requirements that they may bring in on top of the normal, let's just have the profit, the numbers, and so forth. What would you say to such an entrepreneur in terms of appreciating impact investors and the kind of questions they should be asking to make sure that they are comfortable? And I know we are switching hats here just for a second, because I think it's important because I've seen some names here that that's one of their burning questions.
Yes, I think this is great. And I advise, our own portfolio all the time when we're doing follow-on funding. So if you're a social entrepreneur or an entrepreneur running a company, the first question you need to ask yourself is, why should I change my model just so that I can please one or two impact investors? That is a red flag immediately, Stephen, because as an entrepreneur, you have a vision, you have clarity about what you're trying to do. But if you find yourself twisting and changing your basic revenue model or your business model, just so you can satisfy one or two impact investors, you're on the wrong path. My advice is, say to the impact investors, thank you, but no thank you. I'll speak to you in a few years. Let me just crystallize my vision. So immediately, I know you're all thinking, oh, it's impossible. You're an entrepreneur and you're raising money. And no, this is the thing you have to do from the very start. You have to see no as a full sentence. That's the first thing. Second thing is you have to diligence this potential impact investor. And I call some of these impact investors, I call them wolves in sheep's clothing, Stephen, because unfortunately we have a large group of investors who label themselves as impact investors who are not. They're looking for above market returns. They're looking at holding periods of 5 years and less, and they push for blitz scale growth from the outset. That is not an impact investor. So you as an entrepreneur, you need to really understand the question to ask to determine if this person is just clothing themselves in something that they really are not. How do you determine that? Look at their portfolio. Very easy. Say to the investor, give me 5 companies you've invested in the last 5 years. If Paystack is in that category, you're in trouble. Sorry to be a bit facetious, but I just think there are certain types of companies that investors will flock to, who may not necessarily be looking for impact, but quick exits. So ask that question. Show me your portfolio. Show me what you've done in the last couple of years. And then the third question, lastly, ask, what does impact mean to you? How do you measure impact in your portfolio as a whole? If the impact investor is silent there, then you know there's a problem. Can you hear?
I'm going to request you to go back to the third question. You say the third question, and we were all waiting for it, and then you dropped off.
Sorry. The third question is, how do you measure your impact at portfolio level as an impact investor? How do you measure your impact at portfolio level as an impact investor? It seems like a very easy question, but there are lots of impact investors who say they are, but have no idea what the overall impact level is at a portfolio level because they've never measured it. They're just not bothered about doing it. We do it all the time. This is a practice that we have. This is a methodology that we're constantly revising and revisiting. So Stephen, those are sort of like the 3 highlight questions to ask as an entrepreneur, and really think about the responses that you get, because that will help you determine if this is real or if this is just a package set up to just bring you into the portfolio and then push you for blitzscale growth.
Okay, I feel like we just started and we are just ending because it's really the top of the hour. And there's still more questions which are coming in.
Yeah, it's a very big area. And this is why we need a dedicated, day, afternoon, clearly in terms of what Strathmore has done.
Yeah, and so I'm seeing there's a couple of questions, but Kanini, just closing remarks. I know, come in March, we have a whole day to dissect these issues, to turn them around and so forth. So let's leave it at that point. Some closing remarks from you.
Well, yeah, the closing remark for me is this is a very interesting, exciting space. As I mentioned, it's $1.6 trillion, still a lot to grow. But as a philosophy, this is what gives me passion in my life. This is how I deploy my capital. This is how I support entrepreneurs. And I would just really like to welcome you all to what I call, this is a movement at the end of the day. So just welcome me to this movement. Let's get intentional. Let's dig deeper and let's understand the space better.
Yeah. Thank you, Kanini. Really appreciate. If this was a normal Zoom, I would have asked everybody to sort of like use the emoticons to show their appreciation with a clap. I don't know how to do that in a webinar setting, but for me, I think that has been a really good session. Really appreciate your time and for sharing the different insights. More on these once we go to the course. I'll just quickly respond. There's a quick question which has come in around the program. No, the program covers private equity and venture capital. And it not only focuses on impact investing as a philosophy. So the first day is going to be focused on impact investing as a philosophy. But then when you get into the project, then you start going within, along the investing value chain and exit. So all the way from deal evaluations, due diligence, valuations, value addition, exit, and so forth. So, and I think Change can share some additional information if you'd like to get that and even have a conversation with you. I'm sorry that we can't respond to the other questions which have been put in. Gladys, thank you for your comments. We really appreciate. I'm going to pass this on to Change so that we finish on time. Again, Kanini, thank you very much.
Thank you very much, Stephen. Great questions, great conversation.
Thank you, Kanini Mtoni, adjunct faculty and managing director of DREPA, Richard Kaplan, for sharing your very insightful thoughts. Stephen Gugu, we are very honored to have moderated the session, our academic lead for the Private Equity and Venture Capital Program, and also principal at Investor Capital. I know that was the beginning of our conversation that we're not having only here in Kenya, but deep an African conversation. And I'm happy to have participants logging in all the way from Nigeria, very good friends. I'm happy to see you. And yeah, great to have this conversation going. And I know there are quite a couple of questions. And that's the reason as to why we want to invite you to have this conversation going on. And again, I'll reiterate that we have a private equity and venture capital program coming up in the month of March. That is a 5-day long training program. Day one specifically meant for impact investing. And if you want to only join this module alone, it will go at a cost of 35,000 shillings. And if you want to join in for the entire program, Monday to Friday, it goes at a cost of 125,000. We have an incentive that is an early bird discount, which is running up to the 10th of February, 5%. And if you're an EAVCA member, we also get extending a discount of up to 10%. If you really want to ask more, I think I'll display my contact. You can take a screenshot, write me an email, you can give me a call, and I can respond to any query. Once again, thank you to our participants and attendees who were able to join in, our able panelists. Thank you for demystifying impact investing, and I'm sure we've all learned. And I've also, when I'm sitting here, I've also learned. Thank you very much. Without any further ado, I'll call it an afternoon. So I'll invite you to leave at your own pleasure. Until next time, may you have a good time. Thank you and bye-bye.